Behavioural finance has become a buzzword in recent years as investors have realised the importance of counteracting the emotional responses that plague them, which is estimated to cost them as much as 4% a year in lost returns. Earlier, Warren Dick spoke to Greg Davies, the head of behavioural finance at Barclays Wealth, to find out more.
Greg, great to have you on the show, and obviously fantastic to do the interview out here at the Absa Wealth Gardens in Sandton. You, just to give us a little bit of your history, you've done a PhD at Cambridge where you majored, the PhD was in behavioural finance, and it's something that's fairly new in the investment markets. Yep. Let's just get to the reason why behavioural finance is so important, just from your side.
The main reason is that most of our investment returns as investors come not so much from what we invest in, but how we invest. We could be invested in the best possible portfolio for our needs from a financial sense, but if we don't have the emotional resilience to stick with that and to make good decisions along the investment journey, that good portfolio is not actually going to get us good results. The emotional component of investing is at least, if not more important, in our final returns than what we invest in.
So we talk about risk-adjusted returns as often the sort of catchphrase that's used to identify the right path for investors. You've got a slightly different take on that, and this is something you fed into the machinery at Barclays Wealth and Investment. Just tell us what your objective is with your behavioural process that you put clients through.
Absolutely. Well, risk-adjusted returns are important. People need to be compensated for the risk they take, but that's a really small part of the big picture. What people really need is what we call anxiety-adjusted returns. It's not good enough just to get the technical aspects of risk right, because what investors really want is the best possible returns that you can get relative to the stress, the discomfort, and the anxiety you're going to have to endure along the investment journey. And unless we take steps not just to suppress risk in our portfolio, but to actually suppress anxiety in the portfolio, you're going to make bad decisions along the journey, and you're going to harm your investment returns, and of course you're going to be uncomfortable and emotional along the way.
So anxious investors are not good investors?
Anxious investors by and large are not good investors. That doesn't mean that you have to eliminate all of your emotion. Emotion is very important in investing, but we have to use it in the right way. We have to use our anxiety and use our emotion to give us signals of when to be cautious and when not to be. What we have to avoid is these knee-jerk responses that many of us as investors experience. Something happens in the market today or is likely to happen next week, and we let this take over our thinking. It means our decisions are misaligned to our objectives, because as investors, our objectives are about achieving returns over the longer term. And if we focus on our emotional angst about something happening right now to the detriment of good long-term decision making, we're not going to be good investors.
So essentially what we're doing is we're exchanging short-term comfort at the expense of long-term pain or long-term outcomes that are not where we want to be. Just give us a sense of what is that costing investors? You've looked across multiple studies. What's the sort of take on by following these impulses that could be damaging in the short term, what it ultimately costs us in rands and cents or pounds and cents in the long run?
There's two essential categories of ways in which investors sacrifice long-term financial returns for short-term emotional comfort. The one is what we call reluctance. Simply put, being in the markets in the short term is uncomfortable. So one easy way of avoiding that is you just don't get into the markets. And we see this around the world at the moment. Huge numbers of investors are sitting on piles of cash that they do not need in the short or medium term. For a moderate risk investor who should perhaps be in a diversified moderate risk fund, that costs about 5% a year. Now 5% a year is a very expensive way of getting to sleep a little bit better at night. The other big cost is what's known as the behavior gap. It's not money left on the side, it's what we do with the money that's in the market. And we tend to be overactive. We trade too much. We focus too much on short-term events. We do what feels comfortable in the moment, not what's right for our long-term needs. In other words, we tend to buy high and sell low because that's what feels psychologically comfortable. The bulk of evidence suggests that that costs the average investor around 3% per year. It can cost some a lot more. You can imagine an investor who bought at the beginning of 2007 into the equity markets and sold in a panic in March 2009, 3% a year doesn't even come close. But if you add these two together, 5% a year from the money you leave doing nothing, 3% a year from the money that you're actually active with, most investors are costing themselves somewhere in the region of 4% a year. They're buying the emotional comfort they need in a very expensive way.
So that's obviously very expensive way of doing things. But what does this mean now? If we accept that we've got these behavioral biases or flaws in our makeup, you were hired after doing your PhD at Cambridge to come and design a behavioral aspect or component to the investment decision-making process at Barclays. What has the outcome of that been?
Well, you know, all of this that I've been talking about is a nice story, but it's got to be more than a story. We have to turn it into practical, tangible results. So we started to develop tools. We have one which is our financial personality assessment. Instead of just understanding your risk tolerance, your long-term risk-return trade-off, this is a psychometric questionnaire. It takes 5-6 minutes to fill in, but we now have data on over 30,000 high net worth individuals around the world. It will tell me something stable about your financial personality on 6 different dimensions. And 5 of those dimensions are, where are you personally likely to be discomforted along the journey? And then what we've spent the rest of those 6 years doing is saying, once we know that about you, what can we specifically change about your portfolio that will help you as an individual investor to get the emotional comfort you need at a cost of less than 4% per year. It's not about taking the classical finance approach and wagging our finger at you and saying, just ignore your emotions, just leave them alone, it's irrational. It's not irrational to need emotional comfort. It's just that most people get that comfort in a very expensive way. And so by changing the products we give you, by changing your asset allocation, by changing the way we communicate with you in very systematic, objectively determined ways, we can help you to be both emotionally comfortable and to be in the markets at the same time.
Now that's great, but just to dig into that a little bit, I mean, what are some of the outcomes or some of the flaws that you discover or that you learn about a person that can translate into an investment strategy tailored to that particular personality?
Well, I'll just give you an example of one. So instead of just thinking about risk attitude as being my long-term willingness to play off downside and upside outcomes, our second personality dimension is one we call composure. Composure is about your emotional interaction with the here and now, with the present. So someone who is very high composure, quite laid back, blasé individual, you might think that's good, but often these people cost themselves investment returns because they don't pay enough attention, they don't rebalance enough, they don't think about their portfolio in the bigger picture. That's costly. Someone who's on the lower end of that scale, low composure, here's someone who's feeling every single bump in the road day by day, and they're at risk of jumping in and out of the markets, of over trading, of buying high, selling low. Here are 2 investors who might in the long run have the same risk tolerance, but are costing themselves money along the way for very different reasons. And so what we would seek to do for the composed individual, we say you need a little bit of prodding. You need help to stay on top of this. You need to be rebalancing. You need something more systematic in your life. For the low composure investor, engagement with the day-to-day is not your problem. Your problem is being able to rise above that. And so what we will do is seek to give you portfolios that deliberately smooth out that journey, that deliberately seek to make you comfortable along the journey so that you can actually get to your destination.
We talk about the skills deficit recognition that you actually become aware of with clients that go through this questionnaire, this process that you do with them. But we've been talking about this active versus passive debate. I was quite interested to find out how this actually translated into an active passive decision in the portfolio.
Yeah. Well, of course, the active passive debate has been going on for decades and probably will continue to go on for many decades. What was really interesting in our research when we built this financial personality assessment is we discovered that there's an aspect of personality that inclines people to be emotionally more comfortable with active or more comfortable with passive. So what we've done as a result is to say it's really not our job to take a dogmatic academic stance on this active-passive debate. Our job is to provide clients with good portfolios that make them comfortable. And so we have this belief in skill dimension. If someone comes out high, it indicates that they're naturally more likely to want to seek out the Warren Buffetts of this world. They want the active funds, they want to be able to beat the market or have the chance of beating the market. That's what makes them comfortable. If someone comes out low on this scale, they just do not have emotional comfort with paying someone to try and be too clever on their behalf. Even if they get a good investor, but markets are going down, even good active investors are going to lose money in bad times. The first question that pops into this investor's mind is, why am I paying for someone to lose me money? And so for them, honestly, the right approach, regardless of whether the active funds are good or not, is to put them into a passive portfolio, because that's what makes them most comfortable. So for us, we have a due diligence team that is very good at selecting good active funds, but we also have an open architecture platform with a full range of passive funds. We select these on the basis of what makes each client comfortable, not on the basis of us trying to impose our investment views on that client.
So we've got this situation now where you find a way to invest that makes sense for the client, but that's emotionally comfortable for them. How have you taken the process from the initial survey or this personality questionnaire that you do? How do you take that through into the investment decision-making process, where it touches on things like asset allocation,
Yep.
and reporting, financial reporting to the client?
Well, it's really important. You hear a lot of people use the phrase behavioral finance these days, and you put a picture of a brain on your PowerPoint presentation and suddenly you're talking about behavioral finance. For us, it's really crucial that we don't just talk about it, we do it. So actually our asset allocation methodology uses behavioral finance, and it plugs into the very mathematics of what we're doing. We link our personality scales to the way in which we build the models for different risk profiles of our clients. At every step, what we've been trying to do is to make sure that the ideas and concepts we're developing here are plugged into our IT systems, are plugged into our product development, are plugged into the sales processes that we use. And we spend an enormous amount of time training our advisors on these processes, building for them tools that they can have on their desktops that will help them take all this knowledge and turn it into practical solutions for clients. So really we're trying to make sure that the behavioral stuff, which we believe is so important, becomes easy to use and pervades everything every aspect of our process along the way.
I just wanted to ask a final question before we wrap up here, and that's obviously, was there any resistance from the client in doing this, in going through this process? Did they view it skeptically, or was it something they've adopted quite easily?
It's a mixed bag. There were definitely clients who were skeptical at the beginning of the process. 5-6 years ago, behavioral finance was relatively unheard of. There's always an inclination on the part of some people to think, oh, it's new, do I need this? Is this what I need in my life? I have to say, right now the picture is much rosier. It's much easier to get people to believe in this because, particularly with the financial crisis, 2008, 2009, people became very, very aware that the role of emotions in investment returns is high, and it's very, very important. So these days it's actually markedly easier to sell this to clients. And also the fact that we at Barclays and at Absa Wealth have been doing this and thinking about it for so long means that we have really good, solid, robust, data-driven answers to the skepticism that comes our way. So I think for all of that we're still only scratching the surface of what behavioral finance can do in commercial application and investing, but it's good to be at the forefront of that process.